joining us from JM Financials on the technicals, and Sandip Sabharwal joins us on the fundamentals as always. Good morning, Avani. Good morning, Sandip. Just wanted to begin by asking you, Sandip, about the entire auto sector. Now, this is something that has been building up since last week when we were talking about how the waiting periods have come off quite sharply. There was that chatter of increased discounts, etc. And today you have JP Morgan as well as Citi downgrading the auto sector, saying that most of the positive levers are in the price. What's your view on autos right now, and any specific name that you might still suggest as a buy?
I think it will be too premature to write off the auto sector simply because of the fact that the sector has done reasonably well in a period where consumer demand was subdued. There's a likelihood that consumer demand could actually improve going forward as the festival season kicks in, the rural economy recovers due to the cash dolouts being given by the governments as well as normal monsoons. And interest rates overall peaking out, although they are not coming off in the near term. And there was an inventory build up. That inventory build up is getting corrected, and I think most auto companies have aimed to correct it prior to the start of the festival season. Input costs continue to be benign for the sector, and that's a very good positive because all of us know steel prices are at multi-year lows, and that is the biggest cost component for auto companies. So all in all, I think it's in a stage where there will be a phase of consolidation, but I think the longer term outlook still remains good. So among the four-wheeler companies, I would think Maruti and M&M long term should still do well. On the two-wheelers, after a sharp improvement in sales, there is some growth issues which seem to be coming up in the near term, but I think longer term it should be okay. But the valuations are a bit high. But I think Bajaj Auto is the best company there, but not at these valuations on corrections.
Okay. Sandeep, have you changed your mind about Ola, the post IPO and its listing? It's pretty much doubled from there.
Yes, so I think near term, like all of us know, it's all about liquidity. So how many people want to buy vis-a-vis what the number of people want to sell. But the stock was expensive at IPO. It becomes more expensive now. So I think you cannot change because of that.
Right. Sandeep, the other side of the coin has also been FMCG, right? And especially the entire staples cluster, to broadly put it, and how the market is now betting in on a revival. Do you think it's moved beyond tactical a trade? And do you think there is material benefit in now switching out of some of the performing sectors perhaps and taking concentrated bets into FMCG?
Yeah, FMCG is a good sector to be in, but these are stocks which will not give you 50-60% kind of return. It's never been a sector which gives returns like that. It's always a steady return sector. So as the demand revival plays out, as input costs continue to be benign for like palm oil prices are hovering near year lows rather than being high, so that benefits many of these companies. And many other companies have also indicated that they don't see pressures on input cost pressures affecting them. So I think it will be a steady return sector, but at current valuations where everything, even cyclical companies are trading much higher than the valuations of growth, steady growth companies with moat like consumer companies, etc. It makes sense to have some allocation, but you cannot have a huge amount of your portfolio in that. I think having a decent allocation makes sense.
That's a view coming in on some of the staples, but looking at what's been happening for the last few days, it does look like 3-2 is something which has hit the box offices with quite a bit of enthusiasm. In fact, for the first 3 days itself, that movie managed to clock almost 90 crores in box office collections, and now analysts like Abneesh of Novama are talking about how the global collection could be close to 350 crore. All of those graphics will come up for you on the screen. But Avni, wanted your sense regarding PVR Inox. The stock has been a bit sideways of late. What would you recommend on the charts?
Good morning, everyone. So yeah, PVR Inox has seen a sideways movement and it is still consolidating within a band. So I don't think we are looking at any big up move in the stock. It is still consolidating. The breakout level for this particular stock is around 1530. So as long as it does not cross 1530, we are not looking at any explosive move in the stock. This is a temporary up move, a pullback, you can say. And on the downside, again, it can retrace back to around 1445. So it's a range bound stock, 1445 to 1530 on the upside. Only when this range is broken, the stock breaks out of on either side of this range, then we should be seeing a move of another 8 to 10%. Till then, it's a rainbow stock.
Okay, that's the take coming in on PVR right now. Sandeep, add more to PVR at these levels or avoid?
So I think the exhibition space is in a position where most people assume that the theatrical revenues will never revive, and the case that movies will keep on flopping continuously became the base case. Uh, However, the reality is somewhere in between where uh, there was a phase of extended phase where the theatrical revenues did not do well, and now worldwide also we are seeing many movies are becoming very successful in collecting, showing record collections. So there seems to be some sort of revival again playing out. So the reality lies somewhere in between. So I would think that at current prices, PVR Inox is undervalued. It assumes that cyclically things will never improve, whereas I think things will improve. So it might not be a blue sky kind of scenario where like everything works very well, but I think the stock at these prices considers more negatives than positives. So I would think that there should be upside.
Okay, 80 points higher for GIF Nifty. Sandeep, a channel check in autos is indicating that it is no longer a seller's market, it is a buyer's market. Whether it is availability or whether it is pricing or whether it is delivery. Do you think in the near term it makes sense to perhaps trim some exposure to auto?
Yeah, so if you are overexposed, let's say you have a huge proportion of your portfolio in autos, then maybe yes. But I think, like we were discussing earlier, at the cusp of a possible consumer revival cycle, we cannot assume that the auto sector will not do well. Now, most auto companies have been talking about low single-digit growth, etc. So I think a lot of these things are factored into the prices. Stocks have corrected somewhat from the tops, but I think the longer-term prospects still remain good. And the one good part is that input cost pressures are very benign, so that helps these companies.
There are a lot of brokerage upgrades, Sandeep, this morning that, okay, switch from autos to staples. Rural economy is better. A company like Colgate has seen a 10% jump up in volume. Inflation is coming under pressure. And if inflation subsides, which it is, then typically low ticket items, they tend to pick up fast. Are we in for a good time for FMCG for next, let's say, 2 quarters?
So I think as the recovery plays out, Nikunj, I would think that it will be a 2-year cycle at least of improvement. So I think consumer demand, because last 2-3 years have been subdued because post-COVID we saw huge inflation. So these companies had to increase prices, volume growth suffered, and as a result, volume growth suffered in the subsequent year also. So this is the first year where we have actually seen some price declines and volume growth being much higher than value growth for many of these companies. So I think as that plays out, it should ideally be a 2-year revival cycle at least, not just a 2-quarter one. So I would think that many of these companies could start surprising on positive volume growth going forward.
Materials, healthcare, utility, these are some of the themes which in a sense Citi seems to be indicating is there on the radar. All right, PSUs, Naresh, where are they headed? We may be in a bull market, but some of these stocks are getting rusty. RVRNL or HAL or Mazgaon, are these stocks getting slightly rusty now?
Uh, Looks like so the structure of these names is getting weaker on the shorter term charts. And if you look at the kind of rally we've seen in a lot of these names, it makes sense that we see a 20-30% correction at least from the top. Some of them have done, some of them are yet to do it. So a lot of defense names have done a 20% plus correction. And generally, what we notice after such a correction, the stocks go into a sideways band for multi months, even maybe 6 to 12 months going forward. And there one would expect this to continue. So, would be wary of defense, railways, which have done really well. Power companies, as of now, have not turned around in a major way. So that's a PSU basket one needs to be careful of. But at the same time, there are a lot of PSUs which have gone through a long consolidation, whether it is the whole oil and gas pack or whether there is a company like Container Corporation which has gone nowhere. So my view is we could be seeing a shift in the PSU basket towards oil and gas for the medium to long term. So that's a bit still looks interesting.
These are very sharp reversals actually. We don't realize it. Sandeep, we don't realize it. Like 20-25% reversal in some of the stocks. And you fall more than 20%, technically the stock enters into a bear market, you fall 33%, the stock tide turns. Some of the PSU stocks looks like they've entered into a bear market. I hate to use that term, but that is what the reality is, Sandeep.
Yeah, because valuations of many of these companies became unsustainable. For example, like a company like Arida was trading at price to book of 10 times and more highly valued than any private sector financial company also. Much higher, I think even double the valuation of the most expensive private sector financials, etc. So I think it's a reality check coming post major correction, which could be for many of these companies, like they've fallen 20%, some could fall 50% also. There could be some opportunities which could come up in possibly in some defense stocks, some shipyard stocks, etc., where order flows are very strong. But people need to be cognizant of valuation. Retail holding in PSU stocks is very, very high, and they've been buying on every dip. So I think that's an additional risk.
82 points higher for GIFT Nifty. Nuresh, I want to go back to that whole, Avani, good morning. I'm interacting with you for the first time, so just bear with me. I'm just coming right back to you. So Nuresh, since I called out your name, I just want to take this point forward and complete my question here. Nuresh, the surge in volatility, I'm looking at CBOE Vix and the drop in volatility. How can possibility one read into it? 24 became 60, 60s become 15. I mean, I'm talking about global Vix. What is happening? A huge surge and a big drop.
So this has been the fastest flip in VIX. We went from 15 to 60, 65 on US CBOE VIX, and we went down to 15. Say the craziness is you look at Nikkei, which started the whole move, went from 38,000 to 31,000, 31,500, and we are back to 38,000. So that tells you the whole fear has dissipated in really small amount of time. So for now, it's like a 15-day volatile period. We're just we are back to the same place again. So for now, generally the indication is we are back into the similar previous era, where until we stay below the 20 mark on VIX, markets could continue to remain stable.
Avani, you want to come in on that same point, that how should possibly one understand this entire movement in VIX?
Yeah, good morning, Nikunj, and thank you for having me on the show. As far as India VIX is concerned, I think the average range has become around 12 to 15%. Right now, we are trading below 15%, and that's a good sign for the markets. If at all, once it falls back below 14% and starts consolidating in the range of 13 to 14, we should be seeing Nifty heading higher from here. But it's going to be a slow, gradual movement. No big move, a single day 400, 500 point move, that is not expected. It's going to be a gradual move with some bouts of selling here and there. But overall, the trajectory is positive. On the higher side, the resistance is around 21 to 22%. If at all there are no events. In case of events, it may go up to around 25 to 26%. But in case there are no events, then around 21 to 22% is a resistance level. And whenever the market, whenever India VIX touches those levels, we usually see a good recovery coming in from those levels, and that is exactly what has happened even this time. After we saw a fall right up to around 23,850 to 900, we've seen a very good recovery with India Vix going below 15% level. So now my view is that from here onwards, I think it should settle down in the range of around 13 to 14%, and a gradual move should be seen in the prices for the indices.
Let's spend a minute on this, because this is something which in a sense I am trying to understand, that 24 VIX became 60 global VIX and it has come down to 14, 15. What does that mean, Sandeep, for the near term?
I think, like Nuresh said, the move has been very surprising because the up move and the decline in a single line is very rare. Like, you go back into history of VIX spikes, you'll see that the spike happens, there is a corrective move, and then there's another spike. Typically, two spikes happen, the second spike being lesser than the first spike, and that's the time when markets settle down. This kind of move is uh, very rare, and the key is whether this is sustainable or we see another spike going forward, like we have historically seen. So I think that's how, because like you said, it also surprised me a lot that it was just a single spike and then a continuous decline.
It's a mystery. We'll put this chunk out on digital, decoding VIX, if I may use that terminology. Okay, I'm going to change gears and back to what everybody likes, but it still does not go up, and that is HDFC Bank. Who wants to talk about it? Avani, Nuresh, Sandeep? सबको पसंद है पर स्टॉक नहीं चलता है, right? Okay, ladies first. Let's
Yeah, so HDFC Bank, as you said, it's one of the favorite stocks. Everyone wants to invest in it, but the stock is a very slow mover, and it did see a spike to somewhere around 1760, but then a gradual decline, and now it's in a consolidation phase. So every now and then there is some kind of news flow that comes in, and we see the stock correcting. But if you notice, in last couple of months, it has stabilized with a base formation somewhere around 1540 to 1560 area. And whenever the stock goes back to that level for whatever news flow, negative news flow, it does tend to bounce back. As far as the up move is concerned, it's always slow, but it's a stock that can be kept in the portfolio. And on the upside, it's a long-term investment stock. So on the upside, it should be moving towards around 1800, 1850, but you need to have a horizon of at least 2 to 3 years from here on.
Okay, point taken. So that's the view coming in on HDFC Bank. Yes, other one, what one should do with metals. And let's also put cement in the entire discussion, because with JSW's DRHP coming in and the fact that there could be some price hikes on the anvil, the cement sector might come back in focus too.
The cement is a sector where we see supply increase being much, much rapid than demand increase. So in this, in any commodity industry, it's very tough for that sector to perform if the supply increase is more than demand increase. So these companies have been trying to increase price since the beginning of the year, but have been failing continuously. Post monsoon, there's always some price uptick that might come up, but the earnings picture, what most analysts are expecting, will play out. I think the earning picture will be worse than that. So I would not be very enthused by the cement sector overall. And on metals, we've seen a sharp downtick in metal prices globally. Like, they rallied in the first part of the year and then they fell. But most of the stocks have not fallen in line with the correction in metal prices. I think metal is one sector where we need to be very cautious.
Fair point. I'm just going to shift gears and again talk about good old IT and good old power. Why good old IT? Because IT is promising that it wants to make a comeback, and power is showing signs of fatigue, whether it is NTPC, whether it is Tata Power, or for that matter, all the stocks. So Nuresh, is there a switch now? Exit power, move to IT?
So IT as a whole is looking very interesting. So if you look at the Nifty IT index, we are trying to cross the 2021 highs. Then we go stock by stock. We've started seeing outperformance coming in. So after the initial dip in the last few sessions, they've started crossing recent swing highs. So we've seen a HCL take leadership, TCS take leadership. So looks like IT as a sector could take leadership from par. And also the fact that the mid-cap, small-cap IT names are still down. Some of them are down 20-25% from 2021 highs. So they've not overrun as of now. So there could be opportunities across the whole basket. So one could start looking at the mid-cap, small-cap IT names which have corrected a lot.
Okay. KPIT Tech, 20% higher. Then I think we are in for a good day of trade, let me put it this way. Avani, if we make a new high in this rally or in this move, what could be the outer limit? Are we on course to make a new high and then keep on going higher, or this is just going to be a new high and then consolidation could start?
So I think the consolidation phase is already done. It has consolidated quite a bit. And now from here on, once the IT index crosses 41,240 level, then it should be heading close to around 43,000 level, which is also a 61.8% retracement level of the entire fall from the lows which were from the highs which were made in Feb 24 to the lows, recent lows made in the June month. So around 41,200, above that we should be heading close to around 43,000. So it's not going to be a consolidation phase. It's a fresh breakout, and the entire IT pack looks decent enough for a move of another 8 to 10% from here on.
I'm just scanning through a lot of stocks, and Sandip has already expressed his thoughts on Ola, so I won't get there. But Sandip, it's not just Ola, it is Zomato, it is Paytm, it is Policy, PB Fintech, Car Trade. There seems to be a resurgence in this so-called new tech space. And I want to remind our viewers that a year and a half ago, they were at the bottom of the barrel. PB Fintech had collapsed to sub 400. Zomato had collapsed to 60, 70 rupees. Paytm still has got those issues. Car Trade had also collapsed. So Sandip, what has changed? I mean, our market's getting convinced that growth is real and these companies can grow at a profit with profits also.
So I think after the flack, many of these managements got on just focusing on growth and not on profits. Some of these companies started focusing, and the first company to turn around obviously was Zomato, which was expected given that they operate in a sort of duopoly. But for many of the other companies, I think it's a sympathy move. Longer term stories not as great for a majority of these companies, unlike Zomato. So I think people are looking at Zomato. People think that all other companies can do the same thing which Zomato has done, which might not actually be the case.
Okay. Zomato, UBS. Avani, is there a trade according to you in any of the new tech companies, whether it is Zomato, Paytm or PB Fintech?
So yeah, our view on Zomato is positive, and we've been staying long in the stock since a very long time now. In last 8 to 10 days, it has seen a very good consolidation, but it has not moved up though. But the support level has been maintained very well. The short-term moving average of 10 days exponential moving average on the daily charts has not been breached at all. So it's taking support around those levels. It's still in the consolidation phase. Once it crosses around 270 level, I think we should see a very good move on the upside. The targets for our buy call is around 320. So we are still holding on to the stock, and the view remains positive.
Okay, so that's the view coming in on some of these new age stocks and how they're likely to kind of move from here on. Just taking stock of some of the other big newsmakers, and we of course have Maruti, which is going to be in focus on account of that 850 crore hit that might come to the Q2 profitability. Once the rate settles, we will see how Maruti is likely to pan out. Railway stocks will be in focus on account of the fact that Cabinet had cleared the expansion of metro plans in Pune and Bangalore as well, and ONGC and Oil India windfall tax on petroleum has been cut. In fact, Naresh, on these energy companies and ONGC Oil India particularly, I mean, what a dream run they've had. What do you recommend now? Book profits or just stay put?
So if you look at the short term, yes, Oil India has done really well. ONGC has not done much. And if you look at a little longer term basis, ONGC has been a terrible performer. So the stock had topped out around 300, 320 back in 2014 after elections. And we are still at 320, 330 levels. So that's been almost a 10-year return of zero. Only dividends have come into play. They've been good enough, but that's the case with the longer term charts. And if you go a little back, also back in 2006 to 2008, also the stock was at 250. So over a 15, 17-year period, the stock has done nothing. So when we break out of such longer term uptrends, they tend to continue towards much higher levels going forward. Same is the case with the whole OMC, the whole energy basket. We've seen a BPCL not do much on the longer term basis. Similarly, BPCL was at say closer to 250, 280 back in 2017 and 2019. Today we are at 330 odd levels, so a long period has gone. So structurally, looks like oil and gas is an interesting place. ONGC looks better. Oil India could take a pause because it has moved up almost 100% in the last few months. So I would go with ONGC and a pack of OMCs to take leadership from here on.
So that's the top recommendation coming in on these energy names. Sandeep, on that note, we let you go. Thanks so much for making time and speaking with us. But I wanted to take some mid-cap ideas from our technical experts. Avani, you go first, and I also want a view on Piramal Enterprises apart from your mid-cap idea, because it's after a long time it seems that Piramal Group has increased its stake in Piramal Enterprises. The company has acquired additional 6 lakh shares, which forms almost 0.27% of capital. So some sort of infusion coming in there. A word on Piramal Enterprises and your top mid-cap bet, Avani?
So as far as Piramal Enterprise is concerned, it has seen a good pullback on Friday, but it is still trading below the short-term exponential moving averages of 20 days and 20 days specifically. It has moved above 50-day moving average. There's a gap resistance at around 968 levels. So from a very short-term trading perspective, I think 968 is the resistance level. And once it crosses that level, then we may see the move extend up to around 1005 to 1008. So that's the view. Currently, I wouldn't be very excited to take a long trade in this particular stock.
And your top mid-cap idea then?
As we discussed, the view is positive on the IT sector, and amongst this, in this particular sector, we are pretty bullish on Emphasis and Tech Mahindra. So Emphasis expecting a move up to around 3158 on the upside. And Tech Mahindra is one stock which has given a breakout above 1555 on very good volumes and open interest addition in futures as well, and almost to the tune of around 2%. So, and a positive RSI and moving average crossovers is also seen. So now the stock is well poised to scale higher to the previous weekly swing high of around 1720. So we can go long in this particular stock. If at all there is some profit booking and we see some retracement up to 1560, you can add over there. The target on the upside would be 1720 and stop loss can be kept at 1525.
Your mid-cap bets, Naresh?
So would stick to a buy on AB Capital. The stock, after making that move from on a breakout of 190, 200 levels, went to 245. Made a low of around 195, 200 on election day. It was at the same price as 2 weeks as back. And day before also, it made a bottom around those 200, 205 levels. We saw the first uptick. So a confirmation of a double bottom reversal here. So remains a buy at current levels. Would expect it to go back to 240, 45 levels. A stop loss to be kept at 205.
Okay, let's move on and let's also.
If you like this video, then like, share and subscribe to ET Now.